In this video, I'm going to be giving a market update as well as my portfolio performance, and I'm also going to be discussing 3 core stocks that have had results in the last week, including Amazon, including Argo Blockchain, and also Twitter and the acquisition relating to Elon Musk and taking it private, as well as the comment of the week, which is a little bit more on the savage side, but hopefully opens up a new level of personality or something about me that you may not have already known. So, without further ado, the first thing we're talking about here is Amazon, and now I've taken this from Wasteland Capital on Twitter, and basically this is a good image here that really suggests a lot of things. It's quite a negative narrative with this piece of results, but I'm very much interested in what is actually said here. Now, they say it's over, a story of a broken business showing soon on Prime Video. Quite funny in that opinion. What they've said is operating cash flows decreased 41%. Free cash flow has also decreased by apparently almost $20 billion according to them. What I'm interested in though is the growth of AWS, or Amazon's Web Services. Now that has grown 34% annually over the last 2 years and seen a 37% growth year over year in the first quarter, which they therefore say is bad because it's less than Google and Microsoft. But then again, I think AWS is much larger than Google and Microsoft, and therefore it's more or less of a scale thing coming in. A business growing that fast year over year on each quarter, where it has a lot of earnings compared to where the revenue is a very promising business model, and I do like their retail aspect. There seems to be a lot of hate at the moment with the fact of Amazon's retail isn't able to keep up. You can really see a clear example of economies of scale being shared and improving over time. For instance, they've said that in the last 2 years they've managed to double their fulfillment network. So that size that they built over the first 25 years has now been doubled in 24 months. And now they say that they're no longer chasing physical or staffing capacity, and the teams are squarely focused on improving productivity and cost efficiencies throughout our fulfillment network. They have said that this may take some time as they go through the ongoing inflationary and supply chain pressures. However, they've mentioned that they have seen better progress in terms of delivery speed performance, as they're now approaching levels not seen since the months immediately preceding the pandemic in 2020. Now, look, this is a very promising sign. It's saying, hey, you know what? Their fulfillment centers are getting a lot quicker. Amazon's prime advantage here, I didn't mean to make that pun, is that they're able to deliver products at a very quick pace. This means they have a factor of convenience here, and this convenience is what makes Amazon so popular. Because they've got such a large and diverse business, they're able to offer a lot of services and products to customers, and because it can arrive in such a short duration, like next day delivery, this cuts out a lot of the competition. After all, why trek into town to buy this certain product when you can order it on Amazon and have it the next day? I'd rather just order it online, even at a little bit more of a premium price. However, we are only seeing net sales increase by 7%, which they say can't even grow in line with inflation, which, yes, is true, but again, it's been a very, very difficult quarter for online retail, as we've definitely seen an inflow of people going back to the high street and shopping in retail stores. And they mentioned here actually that the retail stores had done quite well, or somewhere else, which is quite impressive indeed. But overall, Amazon's results I really don't think is bad, and I think it's a quality company, and I think actually their share price has declined by about 15% or something. That was after hours. I'm not sure at the moment, as I am recording as of the UK market being open, but I really like the company of Amazon, and I will be doing further research into it. We've also got Argo Blockchain releasing their 2021 full year results. They've said that their revenue is now at £74.2 million for the last 12 months, although that's likely different because I don't know if they're including the total revenue they made each month and adding it up, or if they're just saying, oh, Bitcoin's fallen by this much, so therefore we've only earned this much. Annoyingly, I know I understand because of their results and where it ends, but they've said that they're unaudited, or their audited results for the year ending the 31st of December 2021. Yet they also use the pricing on their balance sheet of Bitcoin based on the price of the 31st of March, which is likely when, like, the day or within the time period before they sent it off for approval to therefore be on the RNS. However, they're saying that's worth £93.6 million. Well, in the last month, it's down about 15%, so that balance sheet is a lot weaker. And what we are seeing here with Argo Blockchain is, yes, they're mining Bitcoin. Yes, they're growing. They've got their facilities up and running, 2 more data centers. They've got the Helios project where they've now got 200 megawatts of capacity to be there, and they've improved to 1.6 exahash a second. However, look how much money they have raised. So we can see here on the financing highlights that in Q1 they raised £49.2 million in new equity via a private placement. Then they raised in quarter three £94.8 million in new equity via the public offering on the Nasdaq. And then quarter four raised £29.6 million in unsecured debt through issuance of senior notes traded on the Nasdaq market. Overall, there, off the top of my head, we're looking at something like 160 odd million pounds in debt right there, which is already more than the value of the assets on the balance sheet at a price 15% higher. Furthermore, we look into this a little bit more, and they've raised even more money in debt from the New York Digital Investment Group of £19.8 million. Well, this money isn't free, and I'm sure that interest rate is starting to rise here, so you can very much see a concern where they're acquiring lots of debt. And you can see here, actually, where they talk about how they expect to achieve 5.5 exahash a second of hash rate capacity by the end of 2022. That's great. More Bitcoin being mined means more revenue. Good move, and obviously the swapping of their machines is positive. However, they've also said that beyond 2022, they expect to grow their hash rate significantly to more than 20 exahash a second over the next few years as they utilize the remainder of that Helios full capacity. The issue is not with their growth and their goals. It's more or less with how they're going to make that sustainable. Well, they've either got to sell the assets on their balance sheet or they're going to take up more debt. Unfortunately, for shareholders, this isn't a good thing. Yes, for the business, it means it's growing faster, and that's a positive sign overall. But if Bitcoin continues to stagnate alongside the global stock markets, then obviously they're not going to get that much of value, because I think hash rate is increasing in difficulty, meaning it's becoming more difficult to mine Bitcoin, and therefore it's just making the company look even more unfavorable. Yes, I did hold a former position in Argo Blockchain. It's one of my greatest mistakes. I took a 50% loss, and I sold at roughly 94.5 pence. Although if I had continued holding, I'd be down 60 to 70%, which would be a savage drop indeed. So I'm just trying to flag up here a lot of the concerns I've got in terms of debt. Yeah, you could go, oh, they've made this much money, but ultimately it's a concern to me, because if they're able to get the assets and they're able to make have more money available to grow the company, then sure. But because they're unwilling to separate with their Bitcoin and Bitcoin equivalent hodl, it means it becomes a lot more riskier and the debt becomes higher, especially in this environment where interest rates are looking like they're going to increase over time. We don't know if these assets or these debts are fixed. Perhaps the bond issuance of senior notes is going to be fixed, but I remember that being fixed at something like 8.75%, which is extremely high of an interest rate that I don't know if that's even sustainable in that situation. We've also saying that Twitter has posted a revenue miss after agreeing Musk's takeover. So Elon Musk has bought Twitter in a deal worth $44 billion. And I think this is a good thing. I don't think the valuation he got for the company is good, but Twitter overall, I think that really gives him a lot more publicity and a lot of free marketing available, because he knows what the people want and he mentions it frequently on Twitter. Now, they've said that their advertising revenue was ahead 23% year on year, although their costs and expenses was up 35% year on year. So they've got an operating loss of $128 million. Yes, their first quarter revenue was about $1.2 billion, which means overall, roughly, if each all quarters are equal and they're likely not due to seasonal changes, realistically, you're looking at a revenue of about, $5 billion, $6 billion? And he's paid $44 billion for this. It's certainly a premium overpayment, but there's a lot of work that can be done with Twitter, and Twitter, I think, is a platform that can grow. It is, in a way, more unique compared to the other social medias. Not that it can't just be duplicated and copied, because quite frankly, it's a very easy model to copy, but it's already got a loyal customer base, or at least user base, which means it's a little bit more resilient, and it may do quite well, and it's held up well against, obviously, the likes of TikTok, Instagram, and other things, although it's certainly getting behind in that regard. So the business itself isn't of a good quality, but Musk buying it and the fact that they have bought it, I think is promising going forward. But again, I'd like your opinions on this, because I think it's effectively free marketing for his company, and he can make it pretty much into a meme page for all he cares, and he'll likely generate a return on investment because of it. Although because of this, I think Tesla shares in general have been quite bad, and obviously Twitter will be made into a privately held company and will become very much exclusively privately held, meaning that investment is no longer on the stock market. The comment of the week is quite a savage one this week, so I thought it was quite interesting. I wonder if I can just zoom out slightly or move it to the side. It appears I can't, so you're going to have to excuse the fact that it's cut off slightly a bit to the right. Don't you work in McDonald's? No, I don't work in McDonald's. I don't know where you got that from, but I did work in a pub and I still do on a weekly basis. I now work in an office in a finance role that I'm in, a very much broad finance role where I'm doing a lot of things like cash and credit control as well, which is more obviously entry level. And I'm doing a lot of operational finance as well, such as reporting on specific regions and doing a little but a very, very small amount of accounting as well, which kind of combines quite well with my SEMA studies. You're in no place to give advice. Oh, wait, sorry, I've skipped a bit. And still live with your parents. Yes, I live with my parents. I could realistically move out in my area. I think I could with the income I'm currently earning. Although I wouldn't want to because it means I'm sacrificing the amount that I can put into investments. And effectively, I'm sacrificing an advantage that I might as well have anyway. I'd like to question this person. Yes, I still live with my parents, but when did you leave? When did you quit your parents' house? Or perhaps there's a different situation or reason why this was never an opportunity for you. But I'm 22 years old. I think that's fine, to be fair. And I think it's just a little slant there that was kind of thrown in to degrade or try and attempt to inflict pain onto me or something. I'm not sure. But the important point of this comment was, you're in no place to give advice of this nature, kid. Now, that's very true. I am in absolutely no place to provide any form of advice. And that's why people watch my channel, because I'm not here saying, I know this, I know that, this is what you should do, this is what you should do, because I'm talking about the stock market primarily. However, this comment is in relation to something where I was talking about business growth. Now, I wasn't looking at the growth of businesses so that you can invest in them, but rather growing your own business. And it was a post where I was saying, you know what, I'm going to go speak to someone one-to-one for absolutely free. We're going to talk about how you can grow your business. And I'm not saying to make it monetarily. I'm saying because of the impacts and the significant benefits I've gained from having a YouTube channel, for example, which has meant that I have been able to network with certain individuals and put myself in a far better situation. It's very likely that I got this office-based role and they already knew about my YouTube channel before I'd even spoken to them. So it was such an advantage, and it's effectively marketing for itself. So in a situation where I'm in no place to give advice, financially, absolutely not. And perhaps business growth in terms of making money from the business, no. But networking is something that I feel that I've done very well. And I think with a 6,000 subscriber base, yes, there's YouTubers with a lot more than that, but I don't know if they've met individuals from this, and the people that they have met, whether they've got significant influence or capital, allowing you to have certain business opportunities and prospects. Fair play to Christopher for backing me up slightly, but he does also highlight again in this comment, people should not be taking advice from people that, or should be not taking financial advice from people that are non-financial advisors. He could ruin people, but very much it's up to your own opinion what you do. It's not like someone tells you to do something and you do it, because that would be a bit ridiculous. It's all about due diligence, and it's all about finding contrasting opinions online, in my opinion, because quite frankly, I'm not going to go listen to someone that completely agrees with what I do, because I'm going to become very biased towards that strategy, and likely I'm going to miss out on enlightenment in terms of really understanding the bigger picture. So, the portfolio, how's it doing? What have I been buying? Well, in this situation, I've been buying a lot more Boohoo. Now, that's a surprise. I now hold 14,063 shares. My average price has dropped by about 2 to 3 pence since the last update video, when it's now £1.57 per share. I'm pushing this down slowly and steadily. Shares had rocked massively in the last week. It is actually quite surprising that I am only slightly down for the week overall, but because Boohoo did drop to about 74 pence per share, triggered my buys, and I got some shares at a decent enough price, although I didn't get as much as I would like. But again, that's in hindsight. It's very easy in hindsight to say, oh, I should have bought more then. Even then, at the time, you don't know how far it could have gone down, because it was down 8%, I believe, in one day, which was very savage indeed. And in fact, you know what, I think I'm down a lot more for this week. This is a misleading figure, because I have deposited money in the last week and not factored that into my performance. So actually, in reality, I'm likely down about 900 or 800, 900 pounds this week, which as a percentage, I couldn't tell you off the top of my head, but that is a very misleading figure. I'm down significantly for the week now that I think about it, because Boohoo did have multiple 8% days, or down days. I'm going to continue buying Boohoo. Amazon's results were not that positive. I think Boohoo's results may not be that positive as well, which is being released this Wednesday. The next Wednesday coming is when this is being released, and it'll be a big update for Boohoo, as is their full year and annual results, or even their annual report. I can't quite remember. So there'll be a lot of data to dive into there, and a lot of interesting information. It's something I'm going to continue buying as the fundamentals and financials are growing. The business I do believe in, and at the moment their biggest competitor, Shein, has had a lockdown in Shenzhen, meaning their largest port in China that distributes likely a majority of the products coming from Shein, is blocked. It's not moving. There's a lot of ships waiting, and therefore therefore Shein products are taking even longer to be delivered, hence Boohoo's advantage, and they're likely doing quite well from this. And people might go back to the idea of Boohoo and the more local retailers and go, you know what, it's quick, it's convenient, at least in the UK, and that's where I expect Boohoo to do well. I've always said I think Boohoo will be growing very well in the UK, but until they can get distribution set up in Europe and the US particularly, which they are very much trying to do, they aim to do by 2023, and the rest of the world, of course, then once that distribution is set up and they've got facilities in the right places, they can very much mimic what Amazon does and do very well in terms of distribution, because fast fashion, you win either on prices, you win either on delivery times, or you win on designs. And I think Boohoo has already got two of those. It just needs to start winning on delivery times, and that is where its advantage stands. And at the moment in the UK, that is the advantage it greatly has. So in 753 days, I'm down 43.72%. Thank you for watching. Have a fantastic day.